You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome in. If you feel like the world of finance is being, rewritten faster than you can hit refresh, you are definitely not wrong.
No, you're not. The fintech landscape isn't just innovating anymore. It's aggressively rebuilding the whole thing from the ground up.
The whole thing. The underlying infrastructure of money, of credit, of commerce. All at the same time.
And that's the key, right? It's more than just a slick new app. We're talking about the fundamental rails, the credit scoring, the banking licenses, even the cloud systems they run on. Everything is up for grabs.
Exactly. So for this, we're cutting right to what we see as the most crucial shifts. We're going to get into the surprising new professional roles AI is taking on, the astonishing amount of money being lost to e-commerce friction, and these huge funding rounds that show you exactly who the smart money is betting on.
It's a huge topic. What's fascinating to me is how AI training has moved from this purely technical thing to an industry-specific craft.
A craft, yeah.
We're past the point of models just, reading PDFs. They're learning the messy manual-specific tasks that actually fuel high finance.
And this is where it gets a little weird. OpenAI, the company chasing that massive $500 billion valuation, they have this initiative, Project Mercury. And they aren't hiring more software engineers. They're hiring over 100 former investment bankers.
From Goldman, JPMorgan, Morgan Stanley, all the big names.
Right. And these contractors, they're getting paid around $150 an hour for what?
To do homework, essentially. Their job is highly specific. Submit one perfectly structured Excel financial model every single week.
So they're not advising on deals. They're teaching the machine.
They are teaching the AI, the nuance, the formatting, the industry expectations for like an IPO model or a complex restructuring. This is how you make AI profitable on Wall Street. You teach it the unwritten rules.
But wait, if you need $150 an hour of bankers to do the manual labor, doesn't that sort of suggest the AI still lacks that core financial intuition?
It absolutely does. It suggests they need the human brain to structure the data first before the models can really scale. It's that classic last mile problem.
Okay, so while OpenAI is tackling it from the outside, the big banks are bringing it all in-house.
At a massive scale.
Citi is the big example here. They've got something like, 180,000 employees now using their own internal AI tools?
That's right. And that level of deployment has a direct impact. Citi is reporting over 1 million automated code reviews.
Which frees up 100,000 developer hours every week.
Every single week. JPMorgan's pushing hard, too. Though, we should be fair, not everyone's there yet. The CFO at Wells Fargo basically admitted their efficiency plan is still, a work in progress. It's a huge ship to turn.
The big idea here, though, seems to be that AI is becoming so embedded that it's almost invisible, which leads to this concept of hidden AI.
Yes. This is a strategy built entirely on cost advantage. Instead of selling a product that screams, buy our AI tool.
Right, no one wants that anymore.
Startups are embedding AI deep into their operations. They use it to attack the single most expensive part of their industry's cost structure.
So like an insurance carrier using AI to just crush their loss ratios, or a broker using it to slash their operational expenses.
Exactly. The customer never sees the word algorithm. They just get a better, cheaper product from a company that suddenly has this almost monopolistic cost advantage.
But all of this hidden AI, this internal AI, it all sits on something very real and very fragile.
Digital infrastructure. And we just saw how fragile it can be with that big Amazon Web Services outage.
That was a huge reminder about concentration risk, a DNS issue in just one single AWS region.
US East 1, a big one.
And it took down over 1,000 apps, including banking services for Lloyd's and Halifax. It just immediately brings back all those calls to, diversify your cloud providers.
The digital rails connect back to real-world stability very, very quickly.
Yeah.
So we've talked about how companies are saving money on the inside. Let's flip to where they are just hemorrhaging it on the outside.
Unnecessary friction. Global commerce. The numbers from the recent friction report are, they're kind of alarming.
They really are.
Revenue's just being left on the table. If you're selling internationally, get this, 96% of your buyers expect to pay in their local currency.
But fewer than half of sellers actually do it. They don't localize the checkout.
And it gets worse. 1 in 3 buyers, a third of your customers, will just abandon the cart if their favorite payment method isn't there.
And for some sectors, it's almost impossible. Only 6% of software companies say they can sell globally with ease. That is billions just gone, lost to solvable problems.
You're seeing companies fight this at the point of sale, though. Wayfair's a great example. They just expanded their deal with Affirm.
Right, bringing buy now, pay later right to the checkout for Wayfair, Joss+Main, all modern, all their brands.
And they timed it perfectly just before their big Way Day Seals event in the holiday season.
And that really shows you how complex loan origination has become. It's not a simple loan. That financing is underwritten in minutes, right there at checkout.
And then what happens to the risk?
It's often immediately sold off to credit funds through what are called forward flow agreements. Think of it like a prearranged deal to offload the loans so the retailer can offer financing without carrying all that risk themselves.
And on the other side of the purchase, you've got loyalty. Banks are trying so hard to keep customers sticky, but they're often stuck.
Totally stuck, anchored to these ancient core systems that make it impossible to launch, say, a personalized cashback program quickly.
So companies like Plumery are jumping in. They're using AI and modern APIs to let banks deploy these reward programs in weeks, not years, by just bypassing the old stuff entirely.
Bypassing is the key word, and that infrastructure layer, the part you don't see, is where the really interesting stuff is happening. Basis Theory just raised $33 million.
For a payment vault, right, but specifically for something they call agentic commerce.
Agentic commerce. Yeah, it sounds a bit like jargon, but it just means transactions managed by autonomous AI agents.
Okay, so my AI assistant is going to buy things for me.
Exactly.
Right.
And for that to work safely, you need a PCI-compliant, processor-agnostic vault. It's like a hyper-secure digital lockbox that lets the AI do its job without ever exposing your actual card data. They're building the foundation for a truly automated financial future.
Okay, so moving from friction to full-on scale.
Yeah.
All this AI efficiency, all this payment streamlining, it's fueling some absolutely massive global investments.
Oh, the capital flowing into platforms that can handle global scale is just, it's breathtaking. Look at Tempo.
Tempo. This is the blockchain platform that came out of Stripe and Paradigm.
Sure, that's the one. And it just raised a $500 million Series A.
$500 million. For a Series A, that's a monster round.
At a $5 billion valuation. What makes it unique is that it's an Ethereum-compatible Layer 1 blockchain, but it's built specifically for high-throughput payments. They're already working with Visa, and guess who? OpenAI.
Of course, this is infrastructure for digital money, not just, digital coins.
Precisely. And then you contrast that infrastructure play with the global neobanks. Revolut is apparently closing in on a $3 billion funding round.
Which would cement their valuation at $75 billion.
Yeah.
Their growth goal is just, I can barely wrap my head around it, adding 1 million users every 17 days.
1 million every 17 days. They want to invest $13 billion to reach 100 million customers across 30 new markets.
But they still don't have their UK banking license. The regulators are clearly worried their risk management can't keep up with that insane expansion.
It's a real bottleneck. And that ambition isn't just a European story. In Mexico, a fintech called Plaid just raised $250 million at a $3.1 billion valuation.
And they're going from just credit cards to becoming a full bank, basically following the new bank playbook.
They are. And all of this global lending, especially in these new markets, it requires a completely different way to look at risk.
Which brings us to Plaid and their new product, LendScore.
This is a big deal. Plaid is launching a new consumer credit rating. It's on a 1 to 99 scale, and it's designed to help lenders evaluate subprime and near-prime borrowers much, much better.
This isn't just a FICO competitor, though. It's a different philosophy.
A totally different philosophy. FICO looks at your credit history, what you've done in the past. LendScore uses real-time cash flow data, your income, your spending, your savings, and it updates dynamically.
So if you're someone who pays rent on time, keeps a healthy bank balance, but maybe you've never had a credit card, you can finally get an accurate score.
It could unlock billions in safer lending. It connects dots that traditional scoring just misses.
Meanwhile, the ultimate ecosystem builder, Stripe, just keeps adding layers.
They really do. They're now adding safe fundraising tools to their Atlas platform. So you can start your company, take payments, get a loan, and now raise your first equity round, all inside Stripe.
And they're going deeper on crypto. They're rolling out stablecoin support for subscriptions.
Using USDC on Base and Polygon.
And their acquisition, Bridge, is applying for a national trust charter. The goal there sounds wild. To tokenize trillions of dollars of assets under a federal framework.
It's incredibly ambitious. And to wrap all this up, we're seeing this fascinating cultural collision. The creator economy is meeting finance.
You're talking about the MrBeast trademark filing.
MrBeast Financial. It signals that the biggest creators, the people who have the most trust with younger audiences, are about to seriously challenge how that generation saves and spends. A creator-led bank that could completely reshape things.
So let's try to synthesize this. When you pull back, the trends are all connected. First, you have AI getting, professionalized. It's not a toy anymore. OpenAI is hiring bakers.
Right. It's being trained for complex, high-value work. Second, fixing global payment friction isn't optional anymore. It's a multi-billion-dollar problem that has to be solved.
And third, the race is on to build the licensed high-speed global systems to handle it all, whether that's Revolut trying to grow everywhere at once or Tempo building the underlying blockchain rails.
The whole stack, every single layer, is being rebuilt at the same time.
The speed of change is just accelerating. So for you listening, the ultimate takeaway is this. The true disruptors aren't just changing the app's user interface. They are targeting the deep, expensive operational guts of the financial world.
Which leaves us with a final thought to chew on. The most profound disruptions in finance might not come from the companies that are shouting the loudest about their AI. They'll come from the ones using that hidden AI to quietly build a massive, almost unbeatable cost advantage.
So the question for you is, which corner of your industry do you think is about to be quietly eaten by internal AI efficiency? Something to think about.
Spoken Tech for your ears.